So Teladoc is down close to 40% after hours after reporting. Well, how should I put it? A disaster quarter. Now, I've listened to the earnings call already. This video is coming out fresh, so my thoughts are maybe a bit more aggressive than if I would have waited 24 hours, but I don't really care. I'll say this already at the beginning of the video. I don't plan on adding any dollars to my position. I don't plan on selling as of yet because it is now a tiny position. It was a small position before, and now with that close to 40% cut, it's even smaller. So I'm like, let's let it ride and sink with the ship. Now, remember when they said they expect it to grow around 25 to 30% for the next 3-4 years? Well, they revised guidance already for this year. They're only planning on growing between 20 to 25%. There's also a huge miss here, and we're going to talk about that right now. Just so you understand, the picture you're seeing here is guidance from last quarter. So revenue to come between $565 to $571 million. Net loss per share, negative 60 cents to negative 50 cents. Adjusted EBITDA between $51 and $55 million. And then the rest is not really important for the discussion right now. For the full year, they expect to grow 25 to 30%, like we said, 2.55 billion to 2.65 billion. And then the net loss per share, 1.60 to 1.40 in the negative. And now this is this quarter right here. Ignore everything else for now because we're going to go and look at the charts in a bit, but let's focus on this thing right here. Non-cash goodwill impairment charge of $6.6 billion was recorded in first quarter 2022. The non-cash charge had no impact on income taxes. Now, and this is why most of you probably were like, what is this? Why is net loss per share so high? Well, it's basically because of what happened here. Net loss per share was negative $41.58 compared to negative $1.31 in the same quarter last year. Again, this was because of this non-cash goodwill impairment charge. And of course, let's not forget the stock-based compensation is still extremely high at $60.4 million, but quite less than last time, which was $87 million. Now, with regards to the goodwill impairment charge, obviously this was out of the blue, but it was bound to happen anyways. If it was not this quarter, then maybe it was the next one or the next one. But regardless of we should have expected this, $6.6 billion is quite a lot. So maybe management should have prepared us for something like that. They did not. They also mentioned in the last quarter during the call that, well, they expect growth to continue at 25 to 30%. They revised guidance. It's not happening this year. They also expected margins to keep increasing. That did not happen. You will see in just a bit. So that's one of the main reasons why I'm not adding 1 cent anymore. I'm not selling my position right now. I'm just not very confident in management. I'm just not selling because, well, the position is very small. And overall, as you will see, the numbers were not awful, end of the world. They were not good, but it's a close to 40% hit because, well, management basically or lied or wasn't prepared to what was about to become this horrible quarter. Now, before I get into the numbers, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. Alright, so Q1 revenue grew 25% year over year, which was at the low end of their own guidance. You know what? Fine, we'll give him that. Then the net loss per share, we've seen that and the reason why. Adjusted EBITDA came in at $54.5 million, a decrease of 4% year over year, which again was also in line with what they expected. Now, as for full year guidance, they revised it to 2.4 billion to 2.5 billion. That's less than 25 to 30% growth. And as for the second quarter of the year, they estimate 580 to 600 million dollars. And then obviously for the full year, the net loss per share will also be extremely high because of, well, what happened in this quarter. For the next quarter, they expect net loss per share to be between negative 72 cents and negative 60 cents. Full year adjusted EBITDA guidance revised to 240 million to 265 million. That's also down significantly from the expected, or well, the previously guided 330 to 355 million dollars. For the next quarter, they expect, well, adjusted EBITDA to decrease quarter over quarter to between 39 to 49 million dollars. So we're going to see now in these types of charts why I said that the quarter was not a complete disaster. It wasn't a good quarter, but as you can see here, access fee revenue increased 30%, well, close to 30% year over year. Visits fee up 12% year over year as well. Then revenue in the US and internationally also growing 24% year over year in the US, internationally 27%. And here it continues as well. US paid members are up, not a lot, but they're still up. Average US revenue per member is up as well. Again, not a lot at all. You can see the difference here. Unique chronic care members is also up a little bit, not a lot. But then again, could have been much worse if all of this was trending down. Maybe that will happen in the next quarter. We're gonna have to wait and see. But continuing here, utilization is up as well. Visits up a little bit. Platform enabled session picked up quite nicely actually. Livongo member data points is up a lot as well. And then we get this, a decrease in gross margin and adjusted gross margin, and then a decrease of adjusted EBITDA and adjusted EBITDA margin, especially when management told us last quarter that, well, margin should be increasing, and that's definitely not what is happening in this quarter. Now, I'm going to talk about their small explanations that they gave us during the call at the end of this video. This is how the balance sheet looks. So cash, cash equivalents, and short-term investment didn't really change much. Same thing with the second one here, convertible and long-term debt on balance sheet. Nothing changed much. But then operating cash flow, remember last quarter was pretty positive. We were talking about free cash flow and how that was going into the positive, a bit compared it to Tesla in 2019, etc. Went over their investor presentation and their own projections, which at the time were correct. Now we're here negative $32 million. Capital expenditures, capital software development cost, $31 million. Honestly, it doesn't really matter much. And this is again the guidance for next quarter and for the full year. As I said, not 25 to 30%, but more likely 20% growth. And then for the next quarter, only 15 to 19% growth. Really nothing to be excited about. And now with regards to what they mentioned during the earnings call, it was more towards the D2C mental health, so BetterHelp. And the explanation they gave is basically this: higher spending and lower results, to put it simply, all right? They saw that the difference between February and March for paid search and paid social increased by about 10% or so. So their cost of acquisition increased by 10%. And the results of that were obviously negative. And that's why you see also on the balance sheet that, well, advertising and marketing increased quite a lot. Now, they did say that 78% of its sales were multi-products. As remember, in 2021, that was 80%. But 78% sales multi-product is still okay. But the fact that they are seeing that they're spending too much and seeing lower results and then not really acting quickly or maybe looking for an explanation or a solution, I would say, but going directly into the conclusion of, okay, we have to revise our full year guidance because of this, because of a 10% increase in cost of acquisition, especially when they mention that their product is the best in the market. We have this whole suite of products and lots of clients, lots of new deals, etc. at the back half of the year. Remember, there's one client for Primary 360 that was supposed to start at the start of the year, but is only going to start now at the second half of the year. Why should you revise your full year guidance so drastically if you were so confident? Is it just because of this little increase in spending? If the product and, well, everything they said was so great, that shouldn't really have impacted them so much. Then maybe you can add inflation here and there. Maybe the costs of every company, every manager is now looking at cost reduction. Fine. But overall, I don't really have that much trust anymore in management. The only reason I don't sell again is because it's just a tiny position. And as of now, selling just doesn't really make sense for me. But overall, this is also a lesson to learn, especially after what we've seen, what happened with Bill Ackman and Netflix. If the thesis is broken, if you have zero trust anymore in management, cut your losses. Doesn't really matter how much, cut it and put that money to work into something else. Now you might say, so why aren't you doing the same? Well, because it doesn't really matter anymore. It's now close to 1% of my portfolio. I rather not sell it and lose on the, well, it's not a zero commission platform that I'm using. So I rather just leave it there and see what happens. Now, obviously, I would like to know what you're doing with your Teladoc shares. Leave it all down in the comments below and expect a Pinterest video tomorrow and then probably Facebook or PayPal after that, and then Roku and all the other companies will follow on Thursday night. So that will be it for this video. If you enjoyed this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I'll see you all in another video. Bye bye.